are telling me that stick with gold. Obviously, gold, you don't want to be buying an overweight buyer as it gets towards 4,000. It's really overdone. Maybe you look for a dip around 3,500.
They're going to have Bitcoin and gold as separate asset. Yeah, in the same type of risk off bucket. Exactly.
So Bitcoin is not a risk off asset. It's a risk on asset. If you expect that to change, fine. But all the correlations, everything, it's very much a risk asset.
We agree. It has been a risk on asset in every single instance except for one, which is the Silicon Valley Bank meltdown.
Yeah.
The global financial system is showing stress points that few can ignore. Gold's push toward $4,000 signals both confidence in hard assets and deep concern over the stability of fiat currencies. The metal continues to prove itself as the anchor in an environment where fiscal excess, ballooning debt, and relentless government spending are undermining the very idea of risk-free assets. Meanwhile, Bitcoin's role is still debated. Some see it moving into the risk-off camp, but its trading behavior remains aligned with risk-on assets, except during isolated crises, such as the collapse of Silicon Valley Bank. This divergence underscores how investors are recalibrating their views on safe havens in real time. MikeMcGlone, senior commodity strategist at Bloomberg Intelligence, highlights how gold's rise reflects a structural rejection of fiat dilution. At the same time, JamesLavish, an investor and macro analyst, notes to evolving perception of Bitcoin among institutions, where its eventual inclusion alongside gold as a strategic hedge appears increasingly likely. Both agree that quiet, underreported central bank gold buying and relentless Bitcoin hash rate growth signal accumulation happening beneath the surface. Gold's surge is a visible reaction to unsustainable policies, while Bitcoin's gradual institutional acceptance could reshape portfolio construction in the years ahead. Together, they demonstrate that the foundation of wealth preservation is shifting, and investors who ignore this dynamic risk are being left behind. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Good morning. Anna Wong is coming out somewhat bullish. First of all, for non-farm payrolls, she's expecting 54,000. Unfortunately, she didn't mention a percentage rate, but the range is quite large between minus 20K and 100,000K. Her quote was, she thinks large firms are not hiring. It's a productivity cleansing was the term she used, and a lot of that's because of but small firms are. And she says a lot of small firms are unable to fill job openings and they're starting to hire. One bright spot she expects in non-farm is expect leisure and hospitality to show improvements in hiring. She's been mentioning this for a while, and she also thinks that headwinds may start to turn to tailwinds. We have that trade uncertainty and fiscal restraints might switch to once the worst may be past, is her view for the economy in the U.S. Our senior rate strategist Ira Jersey says markets are continue to be range bound, but head towards the lower in the range. She expects 4% to 4.25 in the 10-year note to hold. Expects the steepening to continue, and the 2-year note to leak lower was his key quote. Not much new from our equity strategist. From our FX strategy, Audrey Child-Freeman, says upward adjustments are continue with gross estimates might curtail her dollar bearish view, and she's also kind of curtailed those. And I just pointed out that I just focused on gold, and waking up in the morning when gold's up almost 2% and crude oil's down almost 2%, gold at a record high, crude oil heading towards the 40 level that I've been beating on for too long, is very disconcerting. Now, obviously, the shutdown's part of that. I look at gold as heading towards significant resistance around 4,000. I think it's going to print there, and probably going to see some responsive sellers, and the old resistance around 3,500 is key support. I don't know what really gets it below that, and I just pointed out all these ratios are starting to get disconcerting, like gold versus crude, 59 barrels of crude. It's never ended the year above 39. The last time was 2020. Gold versus Bitcoin back down to 29, getting towards the lower in the range around 25. I'd be much more comfortable doing that gold Bitcoin ratio around 25 versus 35, the all-time high. And then I just point out the trends in crude oil and grains are all the same, held in that low price cure. And I forgot to mention copper is the key commodity to watch. Gotta go up in Q4, and it's right on pace right now, up about 19% in the year, with the S&P 500 about 15%. It seems like it's just running right on the back of the S&P 500 right now.
the Fed meeting is then what, the 29th, right? So October 29th. And between now and then, I'm just scanning through the Bloomberg, list of economic indicators. You have ISM this week, you've got jobless claims, you've got non-farm payrolls and all that. You've got ISM, you've got more jobless claims, obviously. You get the University of Michigan garbage, but you've got CPI, PPI, all coming in before this next Fed meeting and coming in early enough, so like you've got the CPI and PPI coming in next week. So that gives them plenty of time to receive that, actually digest it if they're going to get it, which are important numbers that they're going to be looking for. They're really, they're on edge about inflation, meaning they're concerned that if they continue, the Fed continues to lower rates just to make sure that we don't spike the jobless claims, then you're going to possibly fuel the fire of inflation. And so that's kind of a worry here. So what is happening? The dollar's dropping, and gold is spiking. No surprise. Gold is sniffing out the absolute delusion of fiat currencies and the endless, the ridiculous amount of spending that we're getting out of governments, and that we just expect more of it. They're going to come to an agreement. It's going to be more spending, and whether or not we win the war against paying for illegal immigrants healthcare or not, that's going to be up to Congress and the president. But we're going to spend money. There's no question about that, and too much of it.
Mike, you might have a closer approximation of this. What I read this weekend is the IMF is estimating that 22% of all gold purchases are being reported, 78% are not. And so it's like backdoor buying into Swiss vaults that nobody knows about, and that's one of the hard things to put your finger on, but you're seeing it in the gold price. Like it makes it obvious, And so if you're wondering what's going on and why you're not hearing central banks announcing that they're buying Bitcoin, look at gold's price. If they announce they're buying Bitcoin, what do you think would happen to the price of Bitcoin?
Dave says that
right?
all the time. Yeah.
Right.
You would never front run yourself.
Yeah. You'd front run yourself. So what would they do instead? They'll mine it, which goes to the hash rate. The hash rate is going up relentlessly. Why is it going up? Again, the price is not going up, but the hash rate keeps going up. It's, it's a way to quietly accumulate Bitcoin at a cost that, and slower, but it's a way to accumulate Bitcoin that doesn't advertise it to the world. They're going to have Bitcoin and gold as separate asset. Yeah. In the same type of risk off bucket. Exactly.
So Bitcoin is not a risk off asset. It's a risk on asset. If you expect that to change, fine. But all the correlations, everything, it's very much a risk asset.
We agree. It has been a risk on asset in every single instance except for one, which is the Silicon Valley Bank meltdown.
Yeah.
And it was a risk off asset. Now, I'm like, we don't know what's going to happen. We don't know if we're going to have a black swan, another, catastrophic financial event in this nation. Likely if you're, paying attention to what the hell they're doing in Washington. However, if and when the broad base of investors do understand that's when you start getting it to be allocated small. It's not going to happen overnight. You're going to have some managers go, I think this is risk off. And then the more and more managers who start to understand that, and that's exactly what Scott just said. It's a change of understanding in the lens that you're viewing it through. And, it doesn't matter. Bitcoin's not going to change according to what people view it as. It's not going to change. It's going to continue to be what it is. And it's going to continue to, to organically expand that reach. Not because you have one person comes out and says, oh, I'm going to buy Bitcoin. But what happens when you do have a CalPERS that comes out and says, we're allocating in Bitcoin because we believe it's a long-term strategic asset to protect against the debasement of the dollar. That's a big deal. And that will happen in the future at some point.
Okay,
I don't
so
know when.
I completely respect your view of the future, but to predict the future as a fact is that will go in their gold bucket, right? If they add Bitcoin, which I've been saying that forever, you can't hold gold anymore with some Bitcoin in that space, but at some point it gets too extreme. That's my point at the beginning of the year. They've been kind of thrown off the horse a little bit and still sticking with this year being potential of more of a risk as a risk off year. Haven't been right there yet, but gold keeps outperforming even though we're going up. There's something going wrong here. Either gold backs up 10, 20%, or it gets legitimized by the end of the year by the stock market dropping, which means then we start getting the cryptos to lead the way. And potentially they are.
Okay, but we have to talk about, we can't just end it at January 1st. That we had a major tectonic shift in policy when Trump was elected. You had an administration that was nothing but antagonistic to the whole space.
The Trump administration is one of those.
Choke point 2.0 was real.
Yeah, well, remember, Trump administration one did the same thing. Just like they're pushing back on some of the renewables, they pushed back huge on cryptos too. And Trump won. They flipped. I give them credit for the flip.
This year's performance across commodities is sending a powerful signal. Platinum, silver, and gold have all posted outsized gains, with gold acting as the anchor that pulls the entire complex higher. Historically, the least volatile of the group, gold's outperformance compared to industrial metals suggests deeper stresses in the global system. By contrast, Bitcoin and cryptocurrencies remain firmly in the risk-on camp, with selling pressure emerging as long-time holders take profits after exponential gains. Additionally, Treasury vehicles and corporate reallocations create temporary liquidity lags, further reinforcing the volatility gap between gold and digital assets. Gold is confirming its role as a defensive asset, while Bitcoin is still finding its place in institutional frameworks. Significant funds and pensions have yet to fully adopt it as a strategic allocation, slowed by governance processes that require years of review and approvals. Until then, flows remain uneven, and the market reflects that uncertainty. Amid low volatility in equities and stretched valuations, the signals point toward elevated risks in the months ahead, with gold's strength serving as the most explicit warning. Let's get back to the interview.
So here I like to point out the top 5 performing commodities this year is platinum, 80%, silver, 60%, gold 45%, and then lean hogs. I don't really care about lean hogs, but it's only 25%. So gold's pulling up all this whole space, and that's the key thing. I know people might be nauseated by me pointing out there's only 4 precious metals, and they're all being led by beta and gold. Beta in the space, they're all going up. Obviously, all the elements are much more industrial, becoming more industrial every year. It's a real bad sign when gold beats everything. And then I tilt over. These are typically, historically, gold is typically the lowest volatility and a risk-off asset, store value. Maybe not risk-off, but store value. And then I look over at the other side, the competitive competition in things like Bitcoin and cryptocurrencies. There's unlimited supply and massive selling when they're yelling risks. Now, that's the key thing I'm worried about this year, and this is happening in an environment where risk is on. I mean, significantly on. S&P 500 up 15%. That's great. And if we can keep volatility really low, the lowest in 5 years on a 60-day basis, and this is okay for cryptos. And that to me is the thing that all my spidey senses, a quote I love from you, Scott, and I've learned, are telling me that stick with gold. Obviously, gold, you don't want to be buying an overweight buyer as it gets towards 4,000. It's really overdone. Maybe you look for a dip around 3,500. But the end of this year is not going to make a lot of sense if we keep appreciating the S&P 500 and volatility stays low with gold at these levels. It would make a lot more sense. There's a little modest pickup in volatility. Maybe if VIX gets to near 20, Bitcoin has a little back up to near 100,000. That would make gold make a lot more sense. That's why to me, fourth quarter is awesome. And one of the key indicators I'm using is copper, but copper's been going up for the wrong reasons, for supply disruptions in Indonesia. But again, it's just the key thing is when gold beats everything, you got to be worried, and I'm worried. Very worried about potential for risk asset destruction.
I think that one of the things you said, Mike, and I agree with a lot of what you say about gold. You and I have been on the same page with gold since the beginning of the show. The thing that I want to hit on though is that a lot of the selling out of Bitcoin in particular is coming from OGs that have held this thing from $100, $1,000, and it's up. They're up 100 to 1,000x, and they're ringing the register. And God bless them. Good job. Well done. You became a billionaire. well done. You should ring the register and go live the lifestyle you want to live and diversify into other things, maybe like gold. I mean, whatever. You've done it. So I don't blame them at all. But Dave, you probably have a better handle on this about, that kind of selling. The other thing is we have had a bunch of noise in the Bitcoin world in particular, because we have these new treasury companies that are basically you're reallocating from Bitcoin into the treasury companies, and there's a lag there too. And so that's producing a bit of a lag, because these Bitcoin companies then take that cash and they're going to turn around and buy Bitcoin, but it's taking a while. So they're sitting on cash as they're doing this. And so that's producing a lag that we haven't seen before in M2. And I think that I couldn't get into it. My newsletter was already way past what you could distribute in a single letter. So, but that's also something that's going on that needs to be recognized. So maybe, Dave, I'll let you talk a little bit more about both those things that you probably see in liquidity side of it.
And I see in the data. Also, if you look at volatility, 60-day or 90-day Bitcoin volatility versus gold, just recently it bottomed at the lowest ever. Now, you can easily go back 15 years on that, and it's starting to recover. And to me, this is part of that transitions. We're confirming this year that Bitcoin is a risk-on asset, along with all the cryptos. They're all linked in there as risk-on assets, and we're confirming that gold is becoming more of a risk-off asset. What's the next big trade? And I'm very fearful. Gold's telling us that it's going to be what's happening in China. A little bit of deflation kicking in, a little bit of stock market problem where government has to buy their own stocks, which Japan did for 30 years and China is doing now. And that's why everything in the next quarter is dependent on the U.S. stock market has to stay up, and gold's telling us your risks are it's going to go down, and that means the next trade might be treasuries. And it's all tilting that way. Signals are there. When just the Bitcoin peaked in August, when the VIX bottomed, is not a good sign as we head in the fourth quarter. Now everybody's on top of this trade. I know every hedge fund on the planet knows volatility is low. You got to trade something reverse, and their time decay is killing them. They're getting stopped out. The gamma's hurting them. But sometimes it's gradually and suddenly. And to me, those are the indications. And I'm very, very fearful, as much as I was in 2007 and 6, and much as I was in 1999. And that means if we do have that normal drawdown in S&P 500, which stays down for 20%, it's really good for deflation, really good for interest rates going down, what Trump wants for the next election. But you should expect a 50% drawdown in virtually all cryptocurrencies, most notably Bitcoin.
Let me address one thing here, Mike, because you say this a lot, and we have to talk about this. If you pull up the holders of the institutional buying of Bitcoin through the ETFs, it's not there yet. I'm telling you, there are hedge funds, but you do not have broad-based institutional buying. Institutions. Mike, you know this all too well, having been a long-time bond trader. Who are the institutions? They're not your Citadels of the world. Those are the guys who are whipping around these things and hedging them out. Like, these are massive hedge funds. You're talking about Texas teachers. You're talking about CalPERS. You're talking about massive, massive pension funds and endowments that are in the multi-billions to 10 to 20, 30, 50, 10 to 20, 30, 40, 50 billion dollars that they're sitting on. Okay. That they're the ones who need to be buying Bitcoin and recognizing it as a separate institutional asset. They haven't done that yet. The process and the reason for that is not because they're just dumb. And I actually, one of my recent keynotes, I was up in Prague, and I gave this keynote that was about institutional adoption. And the issue is they've got to go from research to asset class review, then do due diligence. They've got committee vetting. They've got board approvals. Then they've got to have their policy documentation. And then they've got ongoing risk management. This stuff takes months and years for them to do. This is not, and it's structured to do that, to protect the underlying investors, the pension holders, and the endowments from making massive mistakes. So that structure's there for a reason, but it takes so much time. And up until just now, every single person in the institutional world, save for a few, have been highly skeptical of Bitcoin as a separate asset. They're starting to recognize it because it's you can't ignore it now that it's been sitting here over $100,000, a $2 trillion asset in 15 years. And it is starting to solidify as something on Wall Street that's different. And they're recognizing it, but they still have to do the research. They still have to understand it. And then they have to go through all those processes to even get it in front of a committee to start thinking about it as a separate asset, aside from what you said at the first of this, which I still agree with, aside from it being a risk-on asset. So once you start getting people to realize it's a risk-off asset, that's when it starts to be allocated to separately in the institutional world. It takes so much time. It hasn't happened yet.
Okay,
So what we're seeing is at the same time we're seeing OGs dump their coins, because they're just, I'm going to go get my yachts. I'm going to go get my citadels. At the same time, you don't have those massive institutions buying. What do you have? You've got Bitcoin treasuries buying. And those guys those are longtime believers that have figured out an arbitrage between capital markets and Bitcoin. And so that's what's happening right now. You do not have broad-based institutional buying.
The signals across markets are drawing a sharp dividing line. On one side, gold is moving quietly but decisively into record territory, reflecting capital that seeks long-term stability. On the other hand, Bitcoin continues to attract speculation and trading flows. However, the lack of full institutional adoption leaves it vulnerable to sharp swings. Together, these two assets are redefining the landscape, one as the anchor of stability, the other as the frontier of risk. Ignoring these dynamics could mean missing the most crucial capital rotation of the decade. Understanding where money is moving and why will be critical for anyone looking to preserve and grow wealth in a period of mounting global uncertainty. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.